The average true range, commonly referred to as ATR, is a popular technical analysis indicator used by traders across financial markets to measure volatility. Unlike price-based indicators that simply focus on price movements, the ATR provides insights into market turbulence by considering gaps and price ranges over a given period. Scene 1. Imagine a trader named Sam, who closely follows the stock market and wants to determine not just the direction of a stock, but how much it might typically move in a session. Sam opens several charts and notices that prices jump wildly on some days and stay subdued on others. Enter the ATR indicator, a tool that seems to promise clarity. Scene 2. The heart of ATR is the true range, the largest of three values for each period: the current high minus current low, the absolute value of the current high minus the previous close, and the absolute value of the current low minus the previous close. By calculating this for each day and then averaging it over a set number of days, the ATR tells Sam how intrinsic volatility is evolving for a chosen security. Scene 3. If Sam sees the ATR rising, he knows the market is becoming more volatile. Prices are swinging wider daily. A falling ATR signals shrinking volatility and perhaps quieter trading ahead. This knowledge alone allows Sam to adjust his trading strategies, set wider stop-loss orders during high volatility, or choose more conservative trades when ATR is low. Scene 4. For example, Sam decides to trade XYZ Corporation. He notices the ATR over the past 14 days is 2.5 points, meaning XYZ typically moves 2.5 points up or down per day. With that, Sam avoids unrealistic profit targets and sets risk strategies that match actual market behavior. Scene 5. However, ATR is not a directional indicator. It does not inform Sam whether a stock will go up or down. Instead, it helps him gauge expectation ranges and adjust his position size and exit strategies accordingly. It's most powerful when combined with other technical tools, like trend indicators or support and resistance zones. Scene 6. On a volatile earnings day, Sam sees the ATR spike. He knows to trade cautiously, expecting sharp moves and possibly increasing his margin for error. Conversely, as a sector quiets before a major event, ATR drops, signaling a possible breakout push once news hits. Scene 7. Though the ATR doesn't offer buy or sell signals, it serves as a compass for risk management. Sam and other savvy traders rely on it to keep their expectations in check. Every time market drama unfolds, ATR's numbers offer a reality check, shaping how much anyone should bet or hedge. By blending the insights from the ATR indicator, traders can navigate financial markets with greater confidence, understanding not just where prices may go, but how wild the ride could be. ATR remains a cornerstone for disciplined risk management in any trader's toolkit.